Hello, everyone. Welcome to another ACY Securities webinar. I hope you have enjoyed your last week and that you've had some pretty good trading results. But tonight, we're going to go over some of the weeks past. We're going to have a look at what's gone on today. And of course, we're going to have a look at some of your charts. So we'll get right stuck into it today and try and get things on the pace as early as possible. Now, to keep you all in the loop, we do still have a 15% deposit bonus at the moment. So if you are thinking about signing up to an account, then please feel free to check out acy.com/bonus. You'll get a little bit of an extra bit when you do make a deposit there. So bear that in mind. Now, moving forward, a little bit about myself. My name is Alistair Schultz. I'm the Chief Market Analyst for ACY Securities, and I've been trading the markets for more than 15 years so far. At this point in time, it's getting probably closer to about 16 years. And that includes sort of trading in trade floors of New York and across a variety of other institutions that have generally dealt in the fund management space, both boutique and institutional. I'm also a published author of Essentials for Trading Students, a small book that is basically a textbook for some trading methodologies that I learned about when I was younger. So it is a bit of a be-all journey for anyone who might be considering getting into markets. It gives a bit of an idea and an understanding on how many different ways that you can do it, and that there's no right or wrong way to go about trading, just the best way for you. Of course, I also do a lot of coaching and have done a lot of coaching over the years, including with Tim Cahill. And these days I do a lot of guest speaking on Ausbiz TV, and I've been featured in quite a few different places: the Australian Financial Review, Sydney Morning Herald, Bloomberg, FX Street, you name it. I've probably been in there for a brief period. And I'm continuing to do that so now. So at this point in time with Ausbiz TV, I'm on probably about 3 times a week for little short segments, just to give a bit of an idea on what's happening in our markets at the moment. Now, for those of you who might be wanting to get in contact with me or have a bit of a chat with me throughout this session tonight, please do so through the Zoom chat function. The easiest way to do that is at the top of your bar or where you've got your options for Zoom. There is a chat button. Click on that and it'll open up the chat box. If you're not quite sure where that menu bar is, if you're on a Windows PC, hit Alt-H. If you're on a Mac, CMD, Shift and H. And if you're on an iPad, Command, Shift and H. Now, and I would ask that everyone try and use that function, because that's where I tend to keep a focus when people are sending messages. If you are watching from YouTube, then the best way to get in contact would be to actually just leave a comment. Don't use the chat function in YouTube, because once the webinar ends and it stops presenting as live to YouTube, I won't be able to see your question. So please bear with me. If you do have a question, put it in full text and leave it with me, and I'll reply to you most likely tomorrow in the morning if it's coming from YouTube. If it is obviously in the Zoom function, then I will pretty much look at it straight away and be able to give you a bit of an answer. Now, to get started, tonight's agenda, we're going to be looking at a few different things. I've been keeping an eye on what's happening with gold trading at the moment. And of course, this week we've heard a lot about bonds and rates, and obviously bond yields and their own rates, and where we might consider moving to the next part of this reflation trade. So I'm going to have a bit of a chat about that, and of course, what we might be considering with stimulus plans based out of the US, particularly Joe Biden's stimulus plan. And of course, if you have charts, please feel free, send them through. I'm happy to do a bit of a markup on them and try and point out some support and resistance levels, or if we've got any patterns, and perhaps even talk about it from a fundamental perspective, just depending on what that market might actually be. Now, to get started, before we do jump right into it, I do have to give this risk disclosure warning. Now, this statement here basically says that any information I provide tonight is considered to be generalized advice, as I'm unable to give personal advice in this sort of format. So, please bear that in mind. And of course, as an extra, if you are feeling like, some of the information that you do receive tonight is, you're not quite sure what your investment outcomes are going to be, if you're not sure what your experience level is or any of those sort of things, then, it's advisable to seek some extra advice and help from someone who might be able to do so. And of course, if you're still unsure on where to go with that side of thing, then I can sort of help point you in the right direction as to what sort of people you need to be talking to. Now, for tonight's thing, we are going to move forward and have a little bit of a look at some charts. I'm just going to remove that webinar of the PowerPoint for us to get out of the way. Now, the first thing that I do like to do whenever I am looking at charts is have a look at what we've got going on the calendar. Now, obviously, we're in earnings season as well, so it will change on what we are looking at per night. Today, we do have a bank holiday in Japan, but we're now outside of the Asian session and we're moving into the London session. So we do have a little bit of things to sort of think about tonight. Now, unfortunately, Monday didn't have much for us to really think on. We did hear a bit of information out of the ECB with the ECB President Christine Lagarde. And her statement was quite interesting because they've been focusing on bonds as well. Everyone has this focus on bond yields and where they're going at the moment. And I know for a lot of people, bonds are not their primary focus on what they do with them in the market and how they actually work. So I thought I would spend some time just giving a little bit of a clarification and giving some description on what's happening on that front. But for tonight's data, again, we're probably not going to get too much until later this evening. You can see the first one that really ticks up is 9 p.m., which is going to be CPI for the euro. And of course, from there, we have more bond talk at a bit later on in the UK session. Not sure on what time because that's tentative. And beyond there, we're also going to be wanting to pay attention to what Fed Chair Powell says at about 2 a.m. Now, the reasoning, again, for Fed Chair Powell's testimony tonight is he's also going to be talking about bonds. So you can see just how important it is to sort of discuss that side of things. Now, in addition to all of these sort of things we're going to be paying attention to tonight and what I've already covered, I did think it wouldn't be a bad idea to sort of give you guys a bit of a rundown on some of the other things that have gone in tonight's market. Now, the big ones that we have to sort of really take a bit of a think about is, whilst all the bonds and inflation stuff is happening, we've also seen some action happening on crypto markets with Bitcoin. So I'm going to just bring up a chart. Oh, wrong one. This one, here we go. And we might even just bring Bitcoin up to give you guys a bit of an idea. It's already been falling this afternoon. Now, as a general, on the whole, we've seen a few different markets actually moving around and hitting where we don't want them to sort of, not where we don't want them to go, but they have been inadvertently moving in very different directions to what we were assuming they might have been. And this has been a part of the inflation side of the look on where prices are sort of moving at the moment. We've seen, we'll go through some of the charts right now. We've seen US WTI moving up to that $62 mark. UK Brent is also in the same sort of path. And there's even talk of them hitting $70 or $80 at the moment. And this is all a little bit early before we've had our next OPEC agreement too. So, it is interesting to sort of keep an eye on how that's traveling forward. Now, on the Bitcoin front, you can see we've had a little bit of a drop down today. It's already fallen more than, about 10% since this morning. And there's been some interesting news that sort of comes from that. Now, we have spoken in the past about Elon Musk and his ability to sort of interact with some of these markets, particularly on Bitcoin and Dogecoin and those sort of cryptos, and of course Tesla. But in this instance, it's been a little bit interesting. So I think it's almost it's a repeat of a scenario we saw earlier. Now, back in May 2020, Tesla had just done a stock split, and the share price was about $140 a pop. And that's obviously a split adjusted basis. So if you remember, if you know what a share split is, basically, they split. If you had one share before, they split them into, whatever number it may be. Usually it's 4 or 5, and revalue them on the stock price just to make it easier for people to invest in again. Now, that didn't last long. And what we heard was, we heard from Elon Musk at that time at $140 when it had previously been about $1,200. And he said the share price was too high. Now, it didn't really last long because, now the price is well over $700. I think it's about $714 a share. And we've heard recently that old Tesla has purchased $1.5 billion worth of Bitcoins, which to my math works out to be approximately 42,000 Bitcoins based on when they purchased them, which was, the median average of prices in January. So what can we sort of expect to occur from the Bitcoin side of things now? Well, I think of this as a very speculative asset and a very emotionally driven asset class. It's also probably going to bring a hell of a lot more volatility going forward in the next couple of weeks. We know this to already be a very volatile pair. It doesn't take, much to really work that out when we consider, this is how it moves. It is just one of those pairs or one of those trading, there's opportunities to trade that provide some extreme volatility for us all to sort of play with. Now, whilst that's all been going on, this is, it's kind of been an echo response. So Elon Musk's tweet was actually on Saturday. And you would think that, most people would pay attention to that right away. And of course, retail volume traders certainly did. But we don't get that from the institutional side. Institutional guys tend to have their weekend. So they won't have been paying the same sort of attention. And we've seen a bit of a delay in the price action, which hasn't really rolled over until late in the Monday US session. Additionally, something to consider about on the liquidity side is Bitcoin has been declining very sharply on its liquidity. And the reason for that is, a little bit uncertain, but most likely because we're seeing huge amounts being purchased and just being held as a store of wealth, as opposed to transactional and people actually fluctuating their positions. So what happens now? Well, we've already seen the S&P 500 and gold have more liquidity than what we see in Bitcoin. So that means, in very simple terms, that small positions could very, very well have very large impacts on the pricing of it. So certainly, things to consider. I mean, we're already $10,000 down in effectively a single day. This morning it was last night, I believe it was at about nearly 50, or high price, 57,000 US dollars. So, for it to already be back down at 48,000, it does give us a bit of an idea on just how quickly these movements can actually happen on Bitcoin. I wouldn't be at all surprised if we see it tick back down into that $30,000 range before shooting its way back up again. I am kind of long on Bitcoin at this point in time, but it's not my preferred market. It's certainly not something that I want to encourage people to be trading in, just because of how dangerous it can really be at times. Now, if you know what you're doing, go for it by all means, but make sure you understand all the risks that are involved with it. Now, let's move into some of the other things that we might be wanting to consider at the moment. Now, if we were to consider when we think on really any pair, we'll start with gold though tonight, I think, because that was as a part of my focus for tonight's thing. And it's important on the inflation sides of things as well. There it is, the USD. So this here is a gold versus the US dollar chart. We've currently got it on a weekly. We can see, and I have been talking about this, that it has been declining for quite some time. And why is it declining? Well, we have also spoken about that. The reason for it declining at the end of the day is we're starting to see people, before, during the pandemic, when we had no vaccine sort of rolling out, we had lots of people wanting to find somewhere to put their money that would keep it safe. And when we say that, we mean when I say that, I mean from the terms of maintaining its value. So you don't want to put a dollar somewhere that could fluctuate in price, and all of a sudden the dollar you put in there yesterday is worth 50 cents. So in this instance, we're trying to put it into places and use haven assets as a way of control. And when you ran out of the other havens, being the US dollar and the yen and any of those sort of currency transaction side ones, you end up moving in towards commodities. And the most common store of that tends to be gold and sometimes silver as well. Now, why are we still seeing it going down? Whilst we are seeing a bit of a shift in where people want to hold their money, where they want to be dealing with the value side and getting a bit of cash back in their pocket, we're also seeing tech companies actually come down. And if you think of what's gone on in the last year, we've seen how many people investing into tech companies. So, just in today's session, we've seen Asian stocks and US equity futures kind of edge a little bit higher. And in reality, we're sort of, where we're all trying to assess what the jump in bond yields and commodity prices really means for economic growth. For me, it feels like it means we're going to be seeing inflation much sooner than we expect, and likely that we're going to end up looking at some form of a tapering on the bond and asset purchase programs that we've been seeing across the globe, especially from central banks. So right now we have pretty steady gaps between the 5 and 30-year yields in US bonds. We've also seen, the oil side rise as a commodity side of this, and obviously iron ore and steel pricing, and most commodities you can really think of are all rising as well. And so this sort of signifies that people are already starting to change their thoughts about where they go with it. Now, the reason bonds have come into so much focus recently is because it affects the value of the US dollar. Now, while the US dollar hasn't risen yet, it is bound to happen at some stage. And chances are it's likely not going to happen in the near term. And this is because of the huge stimulus package that we are going to be seeing from the US. So please bear that in mind. Now, whilst all that bond talk has been really going on, what's really happening is we're actually seeing a flow of a change in the flow of debt markets. So this is where we start going into bond talk a little bit deeper, but I will keep it pretty light so it's easy to understand. For the last 30 or 40 years, fixed income markets, that is bonds that have a fixed rate of return. You'll get paid a dividend, you know what the face value of that product is or that bond is, and you will know exactly how much in a yield or a rate that you will actually get as a return based on your investment. Now, the reason that the fixed income has been more preferable is because of declining interest rates. So if I'm just going to pull up something for us to have a look at on interest rates on Google while I'm talking, if we look at rates over the last 30 years, we've seen constant declines happening. And when you've got declining rates, it means you are going to end up seeing a little bit of a continual issue of what's to come next. You're not going to those bond markets that you have the option to get ones based off the rate. So I've just got one here for us to have a look at. This one's actually a very long time. This is over 700. Well, no, not 700. 700 years. 1310 to 2018. So bonds have been bonds generally would be tied to your interest rate of some kind. And we can see just on this image that I've got brought up that for a very, very long time, we've been seeing loan rates and borrowing costs all coming down. Where we're at now is that where our rates have gotten so low that in some instances last year, they were negative, which means there was no borrowing costs and that if you were borrowed money from the bank, they would owe you money. Now we're starting to see the inflation tick up and the counter is going to be productive. This scenario basically results in us having to worry about borrowing costs moving forward. And when we look at all the borrowing costs and all the money that, things like Tesla and any of your corporate earnings companies that you can pick out of the NASDAQ have actually found, you will end up with, a scenario where all of a sudden, all that money that they borrowed, they took on, and we'll just put it over here just to give you a bit of an idea. If we were to consider, whoops, how do I get rid of that? There we go. Now, any of these stocks, any of these companies, Tesla, Apple, Facebook, Amazon, Google, Microsoft, anything in the sort of the list in the NASDAQ, you can guarantee almost all of them have taken some form of a stimulus paybook to help them sort of move into the next realm and to help fund a lot of their growth they've seen in the last year. So any of those companies that have had extreme growth, and you'll likely know some of them off the top of your hand. It might be things like Afterpay. It might be things such as Zipco. Could even be Zoom as a stock price, and a variety of others. But mostly it's in the tech side of stuff. Now, if all of a sudden their borrowing costs start to increase, it causes problems for that company, but also it causes problems for the economy because if they have less money, they aren't going to be able to cover those bills. And obviously the people that really get hurt at the end of the day are perhaps the lower class that use their products. So that gives a number of issues, not just for those companies, but also the economy, because if people aren't feeling confident about the economy, they're not going to be buying goods. So what is the solution to this sort of problem? Well, we actually have something called a floating bond. It's called a floating rate note. And a floating rate note is a bond that is tied to the interest rate. So if you have floating rate notes, it means as the interest rate goes up, then theoretically, so does your percentage of return. And in the last couple of days, with all this worry about inflation, we've been seeing institutional funds changing some of their investment strategies. Now, that doesn't mean they're removing all fixed income markets from their playbooks, by no means, but it does mean they're actually pushing, some of these strategies to safeguard against the inflation by purchasing things such as floating rate notes. And this means that they're able to sort of push into that side. So this is kind of the next symptom. So I don't know, I'm pretty sure I have, discussed the idea of inflation and what the reflation trade may look like. And that is, dealing with things like cyclicals as stocks as opposed to the technological side of things. So we're going back to that old money way of things, manufacturing and mining and resources, all those sort of things will tend to pick up. And pretty much any of the stocks that you've seen really poorly performing, retail sector as well, over the last year, will generally start to pick up in that pricing point. So when it comes to the gold side of all of that thing, all of that bond side, the advantage is that as the benchmark rates increase, so do these floats. But that provides a risk for stocks. It means that we might find that some of the valuations that we have on stocks are probably over the top, particularly when they start having to actually make repayments on some of these loans that they actually have. So for the time being, that's not, that's where we're sort of sitting, and people are sort of getting prepared ahead of schedule. Maybe not even ahead of schedule. They're just wanting to be prepared earlier rather than later and find that it's all going to go pear-shaped. Now, moving it back to gold, I know I kind of went on a tangent there and I apologize, but when we move back to gold, we've got this sort of movement all going through the day. It kind of goes sideways, drops back up, and this is a head and shoulders pattern right here, just to sort of point that out. And when we've continued on with it. Now, where we're sitting in price right now, I am actually looking to try and see if I can get to this top line up here. I'm looking for that sort of a move to happen, but I am willing to take profit around here. So resistance levels in the immediate point of time that I'm looking from a longer term chart, we have these 2 points as really big standout ones. We also have this one here and these ones here. Now, interestingly, we've been dealing with these same prices, the 1760, the 1780, the 1830, and the 1850 have all been prices where in gold where it tends to get stopped for a bit on either the way up or the way down. So we are able to sort of summarize that there is probably a fair bit of resistance and support sitting in and around this. Now, one of the other ones we could do, I suppose, is if you want to run with a Fibonacci retracement for some of those of you out there who might like them, you'll notice that where these lines meet up, they do actually sit pretty close to where mine are, with the 0% obviously always going to be that way, but 23.6 and our 61.8 puts us at the $2,000 mark per ounce. So, we are well within the range of looking for price to kind of continue, I think, on the downward side, particularly as people start to move away from that reflationary sort of trade that is actually starting to go on. Now, taking into account what we might find from this US stimulus. Now, we know that Powell is going to be talking about it later tonight at 2 a.m. Australian Eastern Standard Time, or 2 a.m. for me. That is something I am going to be wanting to actually get up and pay attention to. And the reason for that is that we're probably going to be hearing his thoughts on what's going on in the bond side of things. And that bond side, the reason it is becoming more and more important is obviously the inflationary issues that are with it, but also the tapering effects. We've been given guidance that suggests that, over the next 2 to 4 years, I think most places have gone with the 3-year mark, that our central banks have given us guidance to say we're not going to be tapering, we're not going to be doing any changes, and we want to let inflation run hot. That's all nice to say, but if inflation does run too hot, then we do run into an issue. And I think people are forgetting that inflation is designed to run a little bit hot. And there is no issue with it being higher than 5%. It's when it starts moving too quickly for us to actually control it that it becomes a bit of a problem. And so we've got the ECB, the Fed, naturally the RBA, and a variety of other central banks that are all going to be giving a fair bit of focus on this. And of course, when you've got, measures of now we've got retreating coronavirus numbers, we have vaccines being rolled out, we have people going back to work, we have more comfort in the markets than we've probably had before, a hell of a lot of fiscal support and monetary policy support as well, and we're about to get another $1.9 trillion package in. To me, I think we've got roughly 3 weeks before the existing stimulus package expires. And when that runs out of cash, then we get the same road hump scenario that we were seeing before. So we've got sort of Biden and the Democrats trying to push that through as fast as possible. I believe it's March 14 is the date to put on your calendar, because that's the kind of the deadline they've given themselves at this stage. But we know how deadlines work for that sort of thing. They don't really exist. But it's, you know, it's also really probably going to be the first proper test for Democrats on the control of House and the Senate. And the final hurdle is really going to be what they do with the minimum wage provisions in the US, which naturally all of that will affect the US dollar. Now, having a massive stimulus package come out, you can only assume that the US dollar is probably going to decline further in value. Further decline in the US dollar means gold becomes a little bit more attractive again. And that's why we're seeing, you know, this sort of run up at the moment that's going on. With, you know, it's not a huge run up in comparison to what we've seen, but against all other pairs, you know, whether we were to look at the Aussie dollar or the Aussie wherever the Aussie is, let me just pull that up. Even if we were to look at the Aussie dollar, we get the same sort of scenario. We're getting up into the near the 80-cent range, and you know, I do have you know, an anticipation that by the end of this year we will likely see 85 cents, if not earlier. It may even be in the, it's not taken that long to get from the 77 cents. So, you know, we're talking in this instance, a couple of days to really move from 70 cents all the way up to nearly 80 cents. So, or a couple of weeks, I should say, months. But even in that instance, you know, it's not that far stretched to sort of anticipate that by, say, June, with a $1.9 trillion package, that we will see the Aussie dollar continue to rally up and on and above. Now, simple trend lines on this one really sits nice and tight. I have no qualms with that. You can, if you wanted to, move this across like so and give yourself a bit of a range to work with, which is always a nice thing, because when you've got a bit of a top on where you want to go, it means you can short your positions down, all but with a little bit more safety for it and safety nets for it. Now, keeping us back on that gold path, this right here is starting to look like a head and shoulders pattern. So what am I looking for? I'm looking for basically this area to become a little bit of a pattern. The first part that's happening, we've got right now, we've got the first shoulder. So that's this piece. The next part we've got is this piece happening here. The next one up is, this is the head that's starting to form just now. And ideally, I'm hoping or looking for us to have another shoulder jump in here somewhere. And I want it to stay below this first one. And then I want it to come back down. Once price breaks this neckline that I've drawn here, I'm going to place a stop loss here, enter waiting for my long position or my short position to kick over, and then I'm going to try and short it down to the $1,784 per ounce mark. So, you know, we've probably got a little bit to go on this, another couple of hours, and if it all plays out, then this is the ideal scenario. I anticipate that probably sometime around 2 a.m. We will end up getting a result out of this. Now, in moving it down to a 15-minute, it makes it a little bit haphazard, but definitely on that 1 hour chart, it stands out like a sore thumb. So that would be that's my main play I'm watching for tonight. Of course, I'm still thinking on the short book for gold. And whilst I do think we might get a little bit of a rise coming out of it over the near term, it's going to continue happening in the same sort of patterns that we're seeing now. You know, we are getting more people wanting to move their funds into riskier based asset classes that actually do pay a return, as opposed to just a speculative one like we have in gold. Now, Aussie dollar, again, I'm very bullish on Aussie dollar at the moment. You know, we have weakening US dollar constantly happening. We still haven't got the next run of stimulus, which, whilst we might be able to say it's starting to get priced in already, I think it will, you know, even at the announcement that we're actually getting this monster-sized stimulus package, and now that we've got, you know, all this optimism about the COVID-19 response and the relief coming with it, you know, it might encourage them to sort of dust off the old wallet or two. So, you know, for stocks and equities, I'm quite bullish at the moment. For Aussie dollar, I'm also quite bullish. Your euro positions, euro is an interesting one to consider, and it really does give us a really good idea on how much the Aussie is really appreciating, because of all the currency pairs that you might bat against the US dollar or the Aussie on, you do find that it's the Euro Aussie that gives us the best example of that change in pricing. When I can actually find the ticker for it here, which doesn't seem to be appearing on my thing. Or maybe I'm just missing it because I'm blind, but there it is. Found it. Great. Now, this Euro Aussie, just taking it out to a weekly. Now, this here is the absolute, bad point for 2020 in all asset prices. And the euro has stayed pretty well at that 1.25 to US dollar. It's been between sort of 118 at its lowest and 125. So its fluctuations have only been about 700 pip over an entire year, going back and forth. So it's been the most stable currency to really deal with. And the weakness, this is weakness at the top of the Australian dollar, because if you've got Australian dollar strength, then the euro Aussie goes down, simply because of the setup of your quote and base currencies. And so, this is our absolute weak point. Now we're actually appreciating against it. And even if we put that over time, we're now beating our average at the moment, with only things really standing in our way is what we had back in 2011 at parity. So there is a lot of good news coming from that side, especially for the Aussie dollar over the next couple of weeks. Whilst we might not have as much economic data as we've had over the last couple of days and weeks gone past, for the future, we are still going to be getting some pretty convenient information from some of those other currency pairs. So we've been appreciating against pretty much everything at the moment, and I anticipate this direction will continue for some time to come, purely on our commodities-based exports that are really happening, and of course, no coronavirus here. Vaccines are now starting to get rolled out. Economy looks as if it's starting to get back into that real recovery phase. The only downside that we have to really consider is how the bonds are going to affect all of this. Now, I am going to keep on having a look. If anyone has a chart, I'd love to hear from you. Let me know now, and I can quite quickly and easily draw some things up for us to take into account. If not, then that's okay too. I'm happy to sort of put up another chart of some kind and take a bit of a stab at it for us. And of course, if you have any questions, here we go. Jason Tumpy, I'm just going to read this out for everyone. Hi, when you listen to the Fed chair speaking, where could I listen to them also? Thank you in advance. Okay, so for those of you who are interested in listening to what the Fed chair actually says, you can usually, they will live stream them onto YouTube, and you can quite often get them directly from places like this. So this is forexfactory.com, and when he goes live for his testimony, you'll quite often get a little link in here that will pop up. Now, the other place you can do it is you can actually go to the Federal Reserve website, and you might even, I tend to read the statements. Sometimes I will listen to him directly. And it just depends on what time it is. How testimony, that should take us pretty much straight to it. So you'll get them live from places like Reuters and CNBC, but you can also get them in here. So this one's taking us to one that's predated because it's not quite live yet. But when we actually go to the Fed sort of section, you'll be able to get, it should pop up here pretty much immediately. This one's obviously from the sort of last lot in 2020 on coronavirus aid, but we will, they will give updates on that as we go through. So you basically just keep refreshing this page and it should pop up here. The live testimony is also, usually on YouTube. They'll do it, and sometimes they do them on the Facebook pages. So you've got a whole stack of them. This one's probably the best place to go though, because this is the live Federal Reserve speech thing. This video will, like I said, it's all done through YouTube these days. This is their last updated one, so you can re-watch this one, but they will consistently keep uploading that to when it comes. So I hope that does answer your question, Jason. If you are interested in getting a little bit more out of that, I'll probably end up doing a little bit of a talk on it as well tomorrow at 2 a.m. Australian Eastern Standard Time, where we're still sort of in the midst of the US session. You'll just have to be sort of kind of constantly hitting that refresh button for it to happen. The other option is you go to the FOMC webpage on YouTube. So if you go here, when they'll usually, if you subscribe to the channel, when they go live, you'll get a notification on your phone as well. So there's quite a few different ways to do it. I prefer to roll with the alternatives, which is waiting for the written statement, because if you're trying to listen to what they say, then it gets quite emotional very quickly, and that's usually when traders make mistakes. So for me, I tend to just read the statements post, which gives me a bit of time to think about it. Because whenever we hear things from the Fed on these sort of matters, they do, talk about them occurring over a couple of months. So please, don't feel you have to panic and worry about it at 2 a.m. if you don't feel like getting up, though, I certainly will be anyway because of the bond talk. Unfortunately, this time around I will. Not every time is it necessary. So anyways, I do hope all of you guys have gotten a bit out of tonight, and it's helped sort of clear up your thinking for where things might be going over the next couple of weeks. I do believe we are sitting in a bit of a sweet spot right now for our trading in terms of long positions in a variety of different markets. And it's probably worth keeping close tabs on them, though. We are sort of, whilst we're sitting in a sweet spot, whenever you're in a sweet spot, it doesn't take too much to upset your seating, if you will. And with, having had all the wind at our back with bonds for so long, it's moving into an environment economically that, perhaps, when we're not so used to anymore. And it is going to be a little bit of a topsy-turvy ride, but we will be able to get out the other side of it with hopefully some pretty good moves and trades on the way as well. Now, I will wrap it up there for tonight, guys. And like I said, I hope you have all enjoyed it. Now, if you do want to get in contact with me, if you would like to message, whatever it may be, it can be about a webinar from tonight. It can be about anything in the past little while, any of my videos, or maybe you just have a general question about trading, please feel free to get in contact with me. I also have an email address, which is talktoal@acy.com. But I am available on any of my social media ones, so feel free to chuck me a like, a subscribe, and send me a message, and I will happily, give you some answers if I can. Of course, if you would like to catch me on live TV as well, I'm almost always on the drop at 9:40 a.m. on a Tuesday. I will also I'm on the trade on a Monday at 2:45 in the afternoon. And I believe I'll be on the pulse starting from about next week, also at about 3 p.m. in the afternoon on Thursday. So I am floating around a fair bit. And don't forget, in the next couple of days, I'm going to be releasing, I went to the Sydney Gold Vaults with Guardian Vaults and had a bit of a poke around in there and spoke to some guys about the physical side of gold and how it relates to our other side, being where we traded. So feel free to check that out when it does get released. It'll all be through YouTube. And it's about a 20-minute special. So I hope you do enjoy that as well. Otherwise, I will see you all this week, Thursday. I'm unfortunately not able to host a webinar, but from next week onwards, Tuesdays and Thursdays, back to normal, 7 p.m. Australian Eastern Standard Time. And I'll be here to take any of your questions. And of course, hopefully guide you through the markets a little bit. All right, well, I'll leave you all for it tonight. Please enjoy your trading for the week and make sure you stay safe in the market. All right, bye for now.